Hey everyone, welcome to another episode of the Dan Habib Show. I'm your host, Dan Habib, and in today's episode, we are going to do a deep dive on the jobs report, probably one of the most important points of data we get every single month. Also, take a look at next week, which could prove to be a rocky week in the markets, and really a deep dive on inflation. But first, a couple reminders. If you are in the mortgage or real estate businesses and you want the best insights every single day on what's happening, check us out at mbshighway.com. Also, if you're a crypto investor and you want an edge on investing and you want a multifaceted approach, technical analysis, on-chain analysis, coin breakdowns, long and short positions, you name it, give us a look at cryptocharge.com. And if you sign up and use the code Habib, you'll get 40% off of the regular pricing. Lastly, please like and subscribe and follow this channel to support us and me as we're delivering this information to you every week at no cost. But let's jump right into the meat of it, which is the jobs report. This is from the Bureau of Labor Statistics, or the BLS. And as I mentioned before, one of the most important economic reports that we get every single month and can certainly impact the markets as it did today. Estimates for this, right? The market always sets expectations, were for 250,000 job creations for the month of September. So it looks back to last month. And when they collect this data, they collect the data around what's called the sample week, or the week that encompasses the 12th of the month. Well, when they did this, they found that there was 263,000 job creations in the month. Now, this is better than expectations of 250,000. So you might think, well, maybe the stock market and the risk-on markets are going to like this. We'll break down in a minute why they didn't. Also, we got the unemployment rate. The unemployment rate came out and it dropped from 3.7% to 3.5%, which was a big surprise, but did it do so for the right reasons? I created a graphic for you to really help break this down step by step. Now, what most people don't understand is that when you take a look at the jobs report, there's actually two different surveys in there. And one survey you get the headline job creation number from, the other survey you get the unemployment rate from. So the one where you get the 263,000 jobs that were created last month comes from the establishment survey. Now, this data is compiled by actually looking at who's getting paid during that sample week we talked about, as well as some modeling, the birth-death ratio of businesses. How many businesses came online, how many businesses closed, and how many jobs approximately is that responsible for? But because there's so much modeling done, there could certainly be a pretty big margin for error, and we see that evident with a lot of the big revisions that we see from month to month. Now, the last 2 months in this report, they were revised higher by 11,000, so not really any big revisions to speak of. Now, this is where you get that headline job creation number from. But remember, I said there's two surveys. There's also a survey called the household survey where you get the unemployment rate from. Instead of using modeling and looking at payrolls, what they actually do is they call 60,000 households across the United States and they ask them a series of questions. Are they working? Are they unemployed? Things of that nature. Well, this has its own job creation component. And it showed that there was not 263,000 jobs that were created, but 204,000. So not that big of a difference, but also the labor force decreased by 57,000. So we saw the unemployment rate, which is the big one that everybody's looking at, decline from 3.7% to 3.5%. While there was some job creations there, something else that helped this number come down more than I think it should have, and really didn't come down for the right reasons, is that people left the labor force. The labor force shrunk by 57,000 workers. There's also some other idiosyncrasies within this report that most people are not aware of. So if you take a look at this, the unemployment rate that everybody talks about, it's actually called the U3. But if you ask me, the real unemployment rate out there is called the U6. Let me explain the differences to you. So the U3, it basically subtracts out a lot of potential workers out there, removes them from the numerator as well as the denominator, meaning removes them from the unemployed ranks as well as the labor force. And what you have to look deeper underneath the curtain for is that there is 5.8 million workers that are not being counted as unemployed, even though they don't have a job, because they are discouraged or because they're marginally attached to the workforce, meaning these individuals did not look for a job over the last 4 weeks, but they still want a job, so they are not being considered as unemployed or in the labor force. But they're still unemployed. Now, there is a metric within this report that factors this in, and it's called the U6. The unemployment rate for that measure, it did also decrease, but from 7% to 6.7%. I feel that's a much better measure of what the real unemployment is, but most people in the media, most people in the markets are looking at, as well as the Fed, the U3, which is showing now unemployment at 3.5%. The last component that's important with this report is hourly earnings. So how much on average are workers getting paid? Well, this came in and it was up 0.3 from the previous report from August. And on a year-over-year basis, hourly earnings are up 5%. Now, the real thing is how is this going to impact two things, the Fed and the market? Well, as far as the Fed goes, remember, the Fed has been tightening their economic policy. They've been reducing their balance sheet. They've been hiking the Fed funds rate, and they're doing this to try to get rid of this nasty inflation that we're seeing. So now that the Fed saw that, hey, the unemployment rate actually came down and the job market is still relatively pretty strong, this gives the Fed the cover and the green light to continue tightening, to continue hiking. I believe after this report, the Fed's going to go full steam ahead on November 2nd and hike by 75 basis points. But what about the markets? Because we're seeing a reaction that is one that most people probably wouldn't expect. Normally, when you see strong economic data come out, like a pretty strong jobs report like this one, you'd expect the stock market to be flying higher. You'd expect bonds to be lower because typically they're on opposite ends of the seesaw. However, we saw everything sell off today. Why? Because remember, the markets are reacting to what the Fed is going to do. The stock market does not like if the Fed is hiking rates. It causes multiple contraction, makes it more difficult for businesses to do well, and oftentimes causes them to sell off. This gives them the green light to continue hiking. So we actually saw the opposite reaction of what you would see in a normal environment. Now, a couple other things I want to talk about is what to expect for next week. When we take a look, I think it's going to be a tricky week for the markets, especially for the bond market. And here's why. Number one, it's a shortened week. So when there's shortened weeks, a lot of times you have skeleton crews at trading desks. There's oftentimes lower volumes during that week. People could take extended trips. And that means that you can see more volatility happen as there's less volume out there. But additionally, and that's because Monday, the markets are closed. All the markets are closed for Columbus Day. Tuesday, there's really no market moving data coming out. But Wednesday, here comes some of the action. So we're going to be getting the producer price index, which shows you inflation on the wholesale level. But then at 1 p.m. Eastern, we're going to be getting a 10-year Treasury note auction. At 2 p.m. Eastern, you're going to be getting the Fed minutes. This is really an in-depth look at the Fed's last meeting that they had and what was discussed. And we know at that meeting, the Fed was talking tough. So I don't anticipate the Fed minutes to be good for the markets. On Thursday, this is really the big one, team. We're going to be getting the Consumer Price Index report for the month of September. Remember, inflation is what everybody's looking at. It's what the markets are looking at. It's what the Fed is looking at to dictate, is our policy working? Do we need to keep going? And then on Friday, we have retail sales. But let's go back to to Wednesday, to that 10-year Treasury note auction. Those of you that are in the mortgage business or in the real estate space, you want to know what's going to happen with interest rates? Well, I think interest rates may potentially move a bit higher next week because the 10-year auction is important for the markets. What you want to see happen is strong demand for 10-year notes. However, what investor out there is going to invest in the 10-year Treasury note when you have an hour later, at 1 p.m. is the auction. At 2 p.m. Eastern time, you have the Fed minutes coming out. The Fed minutes are coming out talking tough. Bond market's probably not going to like that. So who's going to invest in a 10-year Treasury where an hour later you could see yields go up and bond prices go down? Add to that, the next morning, you have this Consumer Price Index report where I believe you could actually see inflation move up in the opposite direction. Let's talk about why. Well, what is inflation first? So we always talk about inflation, but I want to take a step back and really explain to you what it is. The real definition of it is too many dollars chasing too few goods. That's the definition, team. Why do we have too many dollars out there? Well, we've had stimulus money, trillions and trillions of dollars. We've had easy Fed policy, keeping rates artificially low, promotes borrowing, a lot more credit and liquidity in the system. And then too few goods. Why do we have that? Well, we know COVID really crippling supply chains, and supply chains are still not back where they need to be. But then you have the Fed coming in and hiking rates. The Fed is hiking the Fed funds rate, which is an overnight rate that banks lend to one another. It is a short-term rate. However, it causes personal loans, credit cards, car loans, business loans, which is the big one, to move much higher and get more expensive. So when they do this, what happens? Well, borrowing slows. And then more people go ahead and invest or make deposits with banks because they get a higher rate of return. You know what's crazy is right now you can get a almost risk-free 6-month Treasury return of now over 4%, becoming quite attractive. But this is what I want to talk to you about with inflation. So when we look to the report we're going to be getting next Thursday, this is for the month of September. But how do these reports work? Because everybody talks about the year-over-year readings. They also talk about the core rate of inflation because that's what the Fed is really fixated on. Remember, inflation reports, you have the headline all-in inflation number, and then you have the core reading, which strips out food and energy prices and is what the Fed really pays attention to because energy prices and food prices, they can be impacted by things outside of the Fed's control. For instance, food prices, we know they're being impacted by the Russia-Ukraine war, could be impacted by things like drought or not getting enough rain to crops and having lower yields, which would cause prices to go up or down. But then how about gas prices? Well, we just heard about OPEC now cutting 2 million barrels a day. These are certainly things that the Fed cannot influence with their monetary policy or the tools that they have. So for that reason, the Fed likes to look at the core rate. Well, the way these reports work is this. Every month you get a new inflation reading for the month prior. And if you add all those 12 months up, you get your year-over-year number. So when we're looking at the core rate, currently for the consumer price index, it's 6.3%. But it's a rolling 12-month report. Here's what that means. When we get the September number, which remember we're going to be getting next Thursday for 2022, it replaces the number from 2021. Well, if you take a look, the number from 2021 is only 0.3%. That's a pretty low number to be replacing. Now, yes, it's possible we get a number beneath that and the year-over-year figure declines, but the bar has been set low, and it may be likely that we see a number come in slightly above this and inflation goes in the wrong direction. However, take a look at what happens once you get past October. October, November, December, you could see on a consistent basis 0.6, 0.5, 0.6. What that means, in my opinion, is the economy is going to continue to slow. And as you get to the end of the year, into the first half of next year, I think you could see inflation come down by almost 0.5% each month. I think you could see some meaningful drops in inflation. By the second half of next year, I think, remember, it's important to note, the biggest driver of mortgage rates is inflation. So I believe that you could see by the second half of next year or by the end of next year, interest rates with a 5 in front, maybe even breaking beneath 5%. Now, how about what the Fed's favorite measure of inflation is? It's called personal consumption expenditures. This is different than the consumer price index that we just talked about, which we'll get next week. It's not as good of a measure of inflation. This one only puts like a very fractional amount of the cost that's measured towards putting a roof over your head, which is the biggest expense that we have. And it doesn't look at out-of-pocket medical expenses, which most of us are facing. It looks at things like Medicare and Medicaid, which are artificially lower because of the government. So not giving you as good of a reading. And for that reason, it's no wonder why it's lower. The core PCE rate is at 4.9%. Now, when you see the Fed out there say, we want to see inflation beneath, or we want to see inflation meeting 2%, this is the metric that they're talking about. They're talking about the core PCE, which currently stands at 4.9%. And we'll be getting this in a couple weeks, but the same story here holds true. Take a look at this month we have to get past. September is a very low reading from last year that we're going to be replacing of 0.2. However, once we get past it, you could see on a pretty consistent basis the numbers get much higher, but this is what the Fed's looking at. The Fed wants to see this 4.9% figure come down towards 2%, and when it starts to make progress towards it, that's when the Fed is stating that they are going to shift gears, slow down hikes, maybe stop, and reverse course on what they're doing with reducing their balance sheet. However, this is what the Fed states. You can't always take what the Fed says for granted because we know if hell goes to a handbasket here and we start seeing the markets crumble, the Fed may be forced to change direction. But team, next week's going to be a volatile one. I'll make sure to break it all down for you. But one more time, just a quick reminder, please like and subscribe below if you're getting value out of these videos, and we'll talk next week.